All right, let's continue on looking at asset valuation and pricing theory. Okay, chapter 7. All right, so let's take a look at an alternative measure of risk or volatility. We talked about this. In managerial finance, and we might have mentioned it earlier in the semester. But let's take a deeper dive into beta. Okay, so beta was developed to measure an asset's responsiveness to movement in the market. This is systematic risk. How does a specific security move in relation to the overall market? Okay, so let's look at the scattergram below right here. This is the scattergram. So we have the rate of return of the S&P 500, and we have the rate of return of IBM, which is a large tech company, the stock of IBM. And so we are comparing how IBM, an individual security, moves in relationship to the S&P 500. So these are the pairs of returns. And then we create what's called a characteristic line, which otherwise known as the line of best fit. You learn this in Math 200 statistics, doing regression. So we're looking basically at a form of regression analysis, and beta is the slope of this line. And so it indicates the relationship between IBM and the S&P 500. Okay? So again, we're trying to determine how a specific security responds to changes in the marketplace. So the market, the S&P 500, is the independent variable, and IBM is the dependent variable. Okay? All right, so a beta of less than 1 means the stock is defensive. It means it is less volatile than the market. Okay? A beta of greater than 1 means the market, the stock, the security is aggressive. It moves more than the market. Okay, so it's -1 to +1. Well, actually, there's no limit on the betas. Anyway, if it's 1, let's see, a beta with 1 moves exactly with the market. Okay, and because unsystematic risk, which is company-specific risk, can be eliminated through diversification, the only relevant risk when you are thinking about putting a stock into an already diversified portfolio, the only relevant risk you look at is the systematic risk, which is beta. So if you're going to add a stock to a diversified portfolio, the appropriate risk measure is beta. Okay, that is what you're looking at when you're considering putting a stock into a portfolio. So the point of the discussion is that the focus of a portfolio manager should be the outlook for the market and how he or she wants a particular portfolio to react to the market. Okay, so if a portfolio manager has a positive outlook for the market and it is appropriate for the client to take risk, okay, then the portfolio manager should or would add to the portfolio the stocks with high betas. If you think the market is going to rise, then you look for stocks that have high betas if it's appropriate for the client to take that much risk. And you eliminate from the portfolio stocks with low betas. Those stocks won't do well in a rising market. Okay? If the portfolio manager has a negative outlook for the market and the client cannot take the risk, then a portfolio manager should eliminate from the portfolio stocks with high betas and add to the portfolio stocks with low betas. So what's your outlook for the market? What is the ability of the client to take risk? How do you want the portfolio to respond to moves, anticipated moves in the market? So since the proper measure of risk of an individual asset in the context of adding it to a diversified portfolio is beta, we need another graph. So there we go, we're going to create another graph. That's what we need. And so here we have it. And so we have expected return on the y-axis. And we have beta, not standard deviation, but beta on the x-axis. Okay? And so we have the real risk, the risk-free rate of return up here on the y-axis. That's the y-intercept. And then we draw a line out that reflects the relationship between the expected return and beta. Okay? So there we have it, the labels for our new graph. Okay? And this line here depicts the relationship between expected return and beta. And this line is called the security market line, the SML, the security market line. Okay? And so what this tells us is that returns are proportional to the amount of risk that is taken. So this reflects the market price of systematic risk. And the y-intercept and the slope of the line will change as expectations for the risk-free rate changes. So where the intercept is depends on what's going on with interest rates. And the slope of the line depends on what the market is paying in terms of return for the additional beta. All right, so we've got a lot of lines. Let's look at the two charts, the two main charts that we discussed in Chapter 7. Okay, the CML, the capital market line, and the SML, the security market line. All right, so the CML uses standard deviation to measure risk. Okay, the SML uses beta to measure risk. The CML measures the relationship between risk and return only for efficient portfolios. So the CML is the new efficient frontier. The SML measures the relationship between risk and return for efficient and for non-efficient portfolios and for individual securities. So we're looking at beta, and we're looking at the relationship between beta and expected return. Okay, so a little bit different. The SML and the CML are somewhat similar in that they measure risk and return, but there are several differences. All right, so let's move over into the capital asset pricing model. As we talk about beta, let's plug it in. Let's see how we find the slope of that line that we just looked at, that characteristic line, that security market line. All right, so the CAPM is the equation that depicts the relationship between systematic risk and of a particular security and the rate of return, the expected rate of return that an investor should require for assuming that amount of systematic risk or beta. Okay? So we know that the total required rate of return for a security, that rate of return that we should expect to earn based on the risks that we're taking, is equal to the risk-free rate plus some risk premium. So we've got the risk-free rate, which is the real risk-free rate plus inflation, and then some risk premium. Okay? According to the capital asset pricing model, the risk premium for an individual stock is equal to the excess expected market return, the amount of return we expect if we were to invest in the overall stock market versus the risk-free security or T-bill, times the beta for the individual stock. So this is the excess return for the market, the risk premium of the overall market, and we're going to adjust that risk premium by the amount of beta for the individual stock. Okay? So what this model tells us is there are three components of expected return for an individual stock. One, the risk-free rate of return. We should expect to earn the risk-free rate of return. Two, we should expect to earn a stock risk premium that has been adjusted by the third variable, which is beta, an adjusted risk premium. All right, let's drill a little bit deeper, get some more detail here. So the excess expected market return is called the risk premium, the market risk premium, and it equals the expected return of the market minus the risk-free rate. That's the excess premium, okay? So let me make this simple for you. There's an easy way, we talked about it in ManFin. There's an easy way to find the historic risk premium for the stock market, okay? And that is the historic return for stocks. Let's use an average number of 10%. And the historic return for T-bills is 3.5%. So the risk premium for the stock market is 10% minus 3.5%, 6.5%. That's the historic risk premium for the stock market. This is the excess return that people have earned in the stock market versus the Treasury bill, the risk-free rate. Okay? All right, so here's the equation for the CAPM. The CAPM, the expected rate of return, is equal to the risk-free rate plus the beta times the expected return of the market minus the risk-free rate. This is the market risk premium. Here's your beta, adjusted by beta. Okay. So the risk-free rate is usually U.S. Treasuries. Okay. Expected return from the market, you can use some kind of educated guess, or you can simply use the long-term average rate of return for the market, and it's been adjusted by beta. There you go. There's the CAPM. All right. The CAPM, in order to use it, there are some simplifying assumptions. All theories have assumptions behind them. All right, so let's look at the simplifying assumptions related to the CAPM. First, there is an assumption that investors only care about the mean return, the average return, and standard deviation. That's the only thing that we look at, mean return and standard deviation. Secondly, investors cannot influence a stock. If you're Warren Buffett, that doesn't hold true for you. It means you're totally passive as an investor. Third, everyone is equally adept at analyzing securities, and we know that's not really true. Okay? There are some people who are better at analyzing securities than others. And remember that all three components of the CAPM, the risk-free rate, beta, and the expected return, change over time. Okay? So for the CAPM to really be effective, you have to correctly project all three of these components, the risk-free rate, beta, and the expected return of the market, into the future. So once again, this is a theory that explains behavior, but it does not generate precise and reliable results in terms of helping you to pick securities. All right, so let's we're going to take a break, and then we'll move on and finish this chapter. Peace out. Shalom.